On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Let's talk about last week's moves before we get to the week ahead. And geez, there's a lot to cover, isn't there? Because last week was a very busy one and a very volatile one. The S&P 500 index in the US actually finished the week only marginally lower. It was only down 0.1%. At some points during the week, we thought it might be down a lot more sharply, but there was a big rally on Friday that saw a lot of parts of the market rebound. So it finished the week just 0.1% down. Growth stocks have obviously suffered the most during this little sell-off. The US tech sector down 9.1% from where it was in late October. But despite the headlines, I think it's really worth pointing out that at its weakest point, its weakest closing point, the S&P 500 index was only 2.6% below its all-time highs. And now it's just 0.7% below those levels. So lots of headlines and some of them look quite concerning, but the broad indices haven't moved as much as they might suggest. Other markets outside the US have been much more resilient, and some have actually performed quite strongly. The UK market was up 1.4% last week, European stocks 0.8% higher, Japan had a great week, the Topix was up 3.7%, emerging market equities down slightly, but they did hit a record high the previous week, and all of those markets that I've just mentioned are comfortably higher in 2026, and all of them are trading at or very close to all-time highs, so it certainly hasn't been all bad out there. The local market, the NZX 50, it was up 0.2% last week. Now, we did miss some of those bigger moves because we were on holiday on Friday, so we missed that Friday trading session in the US actually and that Thursday trading session in the US, so maybe a bit of catch-up for us on Monday. Precious metals, a bit of a mixed bag. Gold rose slightly last week, but silver slumped almost 9%. Bitcoin was down 16.5% last week, despite an 11.5% rebound on Friday. So very tough week for crypto investors. Local interest rates, they were down slightly last week. The 5-year swap rate finished the week at 3.7%. We did see odds for rate hikes come back a little bit. Market pricing right now points to 42 basis points of tightening, and the odds for an OCR increase by September are sitting at about 65-70%. Now, they were at 100% a week earlier, so things have pulled back a little bit. In the US, the 10-year Treasury yield finished the week slightly lower at 4.2%. Treasury bonds have proved to be a pretty good place to hide amongst this recent volatility. Treasury bonds have been up for the last 3 weeks. Right, let's run through some of those key releases that we saw. And here in New Zealand, there was a lot going on. Dairy prices, they just keep surging higher. We saw another very, very good signal for the agricultural sector and the overall economy this year. The latest GDT auction results, the Global Dairy Trade auction results, were very strong. The headline index up 6.7%. That was its 3rd consecutive rise, and it was the biggest gain since March 2021, about 5 years ago. That sees prices up about 15% this year so far and back at October levels. Remember, we had a very poor second 6 months of last year, and that saw Fonterra cut its milk price forecast twice in late 2025. They cut it in November and then again in December. But we've seen a big rebound since then, so maybe we are looking at something a little better than their latest forecasts, which have a midpoint of $9. You know, maybe we're in the $9.50 zone, maybe a little higher, maybe even $10. We'll have to wait and see how things play out, but very good news from the dairy sector. The unemployment report, this was the other key release here in New Zealand, and a mixed bag. The headline didn't look great, the unemployment rate hitting a 10-year high, but importantly, the details looked a lot stronger. This was not a weak labour force report. It was pretty good, actually. Unemployment did rise to 5.4%. That was above forecast slightly, and it was above the previous 3 months, which saw it at 5.3%. So at 5.4, that's the highest we've seen since late 2015, so it's more than 10 years ago. However, the details of the report were much more encouraging. Employment rose 0.5%, that's well above forecasts, actually the strongest in more than a year, and there was a lift in the number of hours worked too. And in the participation rate, that's the amount of people that are actually participating in the labour market, the group of people that are actually putting their hand up and saying, I'm here, I'm available to work, or they're actually working. So when that lifts, that does suggest greater confidence from workers about their job prospects. So you can't just look at the headline unemployment rate, you've got to look at some of these other details and put them all together. And that's why just looking at that 5.4%, which is a little higher than expected, higher since 2015, that is a little bit misleading because the detail was a lot stronger. So another step in the right direction is how I would describe that report. On the central banking front, there were 3 big central bank meetings and they largely played out as we expected. The Bank of England and the European Central Bank left interest rates unchanged, but the Reserve Bank of Australia gave us plenty to focus on. In a unanimous decision, it increased its cash rate by 25 basis points. So that took it up to 3.85%. Now, let's go back and see where the RBA's been. The cash rate across the Tasman peaked at 4.35% during 2023 and 2024, and that was the highest we'd seen since 2011. The RBA then reduced it 3 times last year, and that took it down from 4.35 to 3.6%. Now, that was a much shallower easing cycle than we saw in most other countries. Remember, here in New Zealand, we went from 5.5 and we've gone all the way down to 2.25. The RBA has only gone from 4.35 to 3.6, just the 3 cuts there. But now they have been forced to start tightening monetary policy again because inflation has been stronger than expected. We've seen the headline CPI at an annual rate of 3.8%. You know, we're at 3.1, they're at 3.8. And what they call the trimmed mean CPI, which is the one that the RBA focuses on, that's also higher than they want it to be. That's at 3.3. So not as high as the headline, but certainly hotter than they would like, and the highest in almost 2 years. So in conjunction with that, we've seen a strong economy too. The labour market much stronger than expected. Unemployment dropped to a 7-month low of 4.1% in December. So the RBA is just a little bit worried about a strong economy and hotter than expected inflation, so they've pushed up those interest rates. Now, the next meeting is in March. No changes expected there, but when you look ahead to the following one in May, pricing suggests an 80% chance of another rate hike across the Tasman. So good and bad news coming from Australia. You've got an economy that's in pretty good shape, but inflation a little too hot and interest rates have had to come up again. So that is one reason why the Aussie dollar has been quite strong and the New Zealand dollar is quite weak relative to the Aussie dollar. Turning to the US, we got some good news on the ISM front. The Institute of Supply Management released its manufacturing and its services indices. These are PMIs, they're activity indicators. They cover the month of January and they were very impressive. The ISM manufacturing index jumped to 52.6. So that's the first time we've seen it above 50. 50 is your break-even level. That's the first time we've seen it above that level in a year, and it was the highest since 2022. New orders were up. They were the highest in almost 4 years, and it was a similar story for the services ISM, which actually came in a little lower than expectations, but it was still very healthy at 53.8. That was the 19th month in a row that it's been in expansionary territory above 50. So this was taken very well, particularly that manufacturing index, which has been weak for a long time, and it does tell us that some of those more economically sensitive sectors in the United States are ticking over quite nicely and hopefully might see a more prosperous period ahead. And that does tie in with what you've seen on the share market front, with the likes of US small caps performing very well. The Russell 2000 index is up 7.5% this year. So it's well ahead of the S&P 500, which is up 3%, and that is telling us that Main Street America, small caps are a good representation of Main Street America. Some of those more economically sensitive sectors, outside of tech and AI and so forth, those parts of the economy are faring a little bit better than they have for some time. So good news on the ISM front out of the US. Right, turning to the week ahead, and in a rare turn of events, you don't see this very often in the United States, in the same week we will get the monthly jobs report and the monthly inflation report. Now, the reason we'll get those in the same week is that they have both been delayed by that partial government shutdown, which means that they won't turn up at the usual time and they'll actually come out in the same week. So on Wednesday, we'll get the jobs report. That's the non-farm payrolls report, so it'll be Thursday morning here. And on Friday in the US, we will get the CPI. So that will be out on Saturday morning. I'll get up early on Saturday and I'll run all the numbers and summarize that for you so you guys can just, relax next weekend. So those will be the two key releases out of the US. And what are we expecting? I think from the jobs report, it is expected to be a little bit subdued. The unemployment rate expected to remain unchanged at 4.4%. And the number of new jobs to have been created through January, about 70,000, so relatively modest. You don't want it to be too strong, though, the labour market, because we're all hoping that the Federal Reserve might reduce interest rates at some point in the near future. The inflation report, the CPI report, the market is expecting good news. The market sees the headline CPI and the core CPI both rising at an annual rate of 2.5% in January. Now, that would be the lowest in 16 months for the headline measure, and it would be the lowest since 2021 for the core CPI, almost 5 years ago. So if we get those as expected, then that could impact what markets see from the Federal Reserve in terms of its next move. Right now, markets are pricing 55 basis points of easing over the whole calendar year, so that's basically 2 25 basis point cuts. The first of those cuts is seen as most likely coming in June, so not long to wait before we do see a move downwards from the Federal Reserve. Here in New Zealand, no major releases, but we will get migration. That's out on Friday, monthly migration. The Reserve Bank's latest survey of expectations, that's also out this week. And more globally, investors will be watching the outcome of the lower house elections in Japan. Those are on Sunday, the 8th of February. I'm recording this on Saturday, so it hasn't happened yet. But by the time you listen to this on Sunday or Monday or whenever you get round to it, we will know the outcome, and presumably we'll see a bit of a reaction on Monday from Japanese markets. The reporting season, that will continue, and it's been pretty good so far in the US. We're about, I think, 60% through the reporting season, and earnings growth is sitting at 13% year on year, which is well above where expectations were before the reporting season started. I think we're at sort of 8, maybe 9%, so 13 pretty good, and more than 3/4 of companies have beaten earnings estimates. So it's been pretty good so far. It'll be another busy week. I think you've got about 75 or 80 S&P 500 companies that are due to report results. Who have we got? From all around the world, you've got BP, you've got Coca-Cola, CVS Health, Ecolab, Cisco, Kraft Heinz, Martin Marietta, McDonald's, Hermes, L'Oreal, Unilever, Zoetis. So lots of big names there still to come. Across the Tasman, it's quite a busy one too. New Zealand and Australia, our 6-monthly reporting season starts this week for New Zealand and Aussie. It's a slow start here in New Zealand. We got Skellerup on Thursday, Southport on Friday, but it's next week where things really ramp up here in New Zealand. I'm going to write something and record something about the New Zealand reporting season, what I'm expecting, what I'm looking for. That'll be out probably Wednesday morning on our website and on wherever you get these podcasts, so keep an eye out for that one. But it's really next week that things get busy. However, across the Tasman, it all kicks off this week, Wednesday, Thursday, Friday. Very busy days. We'll hear from 3 of the major banks. Combank, that's the owner of ASB. They are on Wednesday. We've got ANZ on Thursday. We've got Westpac on Friday, also some other heavy hitters, Computershare, CSL, AGL Energy, South 32, Origin Energy, Cochlear, so lots to keep an eye on. So that's all for this week. Enjoy the rest of the weekend, team. Thanks for listening, and let's hope next week is a little bit calmer. As much as I love the volatility because it's exciting, it's interesting, it gives us lots to talk about, I do feel like a quieter week wouldn't go astray. So thanks, team. We'll talk again soon.
For more insights, visit craigsip.com.